There are longer videos that talk about student loans and home ownership that I've published, but this one is quite short because I want to get straight to the point. And the differentiation between being in this pandemic pause with student loans on pause and how it's recognized in what's called the debt to income formula. First of all, what is debt to income? Debt is your monthly debt payments. That's your minimum credit card debt, your car loan payment, your student loan payment, divided by your monthly income. Okay, that is the formula of debt to income. You have to have a low enough ratio so that once you add your mortgage note amount in, they call the back end ratio, which is your total debt to income after mortgage payment, is under 46%. That's the rule of thumb, okay? That's what debt to income is. So now, how does student loans impact that? When we went in the pandemic pause, a lot of loan officers and lenders were using Fannie Mae guidelines of 1%. That means if you held $100,000 of student loans, they would count $1,000 towards your debt to income. Well, if you have a relatively average income, let's say you earn $4,000 to $5,000 a month, and now they use $1,000, that's literally 20 to 25% of your monthly payment obligations is counted towards going to your student loans, which will disqualify you in many cases for home unless you're buying a $100,000 home, which in most markets that will not get you a home. So that $1,000 makes it cost prohibitive, not just to manage, but to buy a home. And they would count $1,000 in this deferment or forbearance pause. If you're in forbearance or this administrative forbearance, even if your payment was not theoretically $1,000 before the pandemic, but they're going by your actual balance, okay? Freddie and FHA count 0.5%, that's $500, which still makes it prohibitive for a lot of people. So what we do at LoanSense is we help people get into a plan based on their affordability or their income. And we help people use their actual payment. So instead of Fannie Mae $1,000 or even Freddie $500, if before the pandemic their income-driven repayment amount was $200, we help the consumer get their actual payment, especially when it's lower than the 0.5, assist with the paperwork so that the lender can show, let's say it's $200 instead of $1,000, right? Help you get that right documentation for close. So how your student loans impact your mortgage is that number one tip is understanding what mortgage loan do you qualify for? How do they treat and recognize student loans? And then what action can you take to get into a plan that lowers and minimizes how the student loans are calculated on the debt to income? It's not just about mortgage close, but at LoanSense, we'll actually help people post-close to manage their student loans over the duration of repayment. And so it's not just getting into a home that's a goal, but staying in the home and sustainably being able to manage your cash flow and your payments so that you don't have a payment spike in your student loans and then be unable to pay them, and as a result get into default that may result in wage garnishment. So it's really important post-close to also manage your student loans properly so that it's not just getting in and attaining, of course, but it's maintaining that home ownership. So again, step one, understanding what mortgage product. Number two, how's it treated? Mortgage product, how's it treated with that product guidelines? And is there anything adjustment you could do, especially if student loans is your highest loan burden, in order to qualify based on your circumstance? I hope that was helpful. If this information is helpful, please like and subscribe, and we will talk to you later.